Yeah, well, the other thing I want to talk about today too was because it happened to you, right? And it's come up a couple of times.
Second segment?
Yeah.
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 Okay.
With appraisals,
Yes.
right?
Yeah.
I want to just role play with you a little bit. You're a realtor.
Yeah, I think so.
I'm a mortgage guy, right?
Yeah,
We're doing a deal together, and we get an appraisal done on a property, and obviously I'm going to get the appraisal. Yeah, I'm going to get the appraisal first. And the purchase price was $500,000 on that property, and I got the appraisal back, and it came in at $475,000.
Mm-hmm.
So I'm going to give you a call, Steve, and I'm going to say, hey, Steve, I got the appraisal back on the DeMarco residence. Unfortunately, the appraisal only came in at $475,000. Your first reaction is going to be what? Before we ever had this conversation, your first reaction was...
So it's either I'm going to want... Okay, $25,000 is not a big deal, so I want my client to put more money down or have a reappraisal.
Right.
But $25K is not enough to do a reappraisal. But let's just say...
Yeah, so what typically will happen in that instance is if this was a conversation with another loan officer and most real estate agents, everybody in the transaction is going to think that buyer either has to come in with $25,000 more or the seller has to lower the purchase price by $25,000, right?
Yeah.
And that is not the case, right? Obviously, the first thing you're going to want to do is see if you can get the seller to lower the price down $25,000.
Sure.
But in the event that the seller doesn't want to lower the price $25,000 and the buyer wants that property because it's the property in the area they want to live in, the school district they want to live in, that's going to be their forever home. They're not worried about a short-term value right now. It's a long-term play.
Fair enough.
The buyer does not have to come in with that $25,000. And the reason why is...
Tell me the reason, Joe.
Here's the reason. Let's say the purchase price on that house was $500,000, okay?
Okay.
And the buyer was putting, let's just say 20% down, right? Because around here, most people are putting 20% down. So times 80%, okay? That means that they're financing $400,000.
Okay.
Okay? And at that $400,000, they were at 80% loan to value. We can keep the loan amount the same, okay? We can keep the interest rate the same. What's going to happen is the bank is going to finance a portion of that money, right? So if you're at $400,000 loan amount, that was the original loan amount.
Yeah.
We keep the loan amount at $400,000. We now divide that by $475,000. That now puts us at an 84% loan to value. So now we are over 80. We're at 84. So now we're in mortgage insurance territory, right? So the borrower now is going to have a choice. They can say, hey, I'll pay that mortgage insurance because on a 780 credit score or 700 credit score and only an 84 loan to value, your monthly mortgage insurance is going to be minuscule. It's probably going to be $50-some a month. Or the buyer can opt to pay what's called single premium mortgage insurance, basically buying that mortgage insurance out. And the cost to buy it out singly on that deal is probably going to be somewhere less than $2,000. So instead
what is that $2,000? You got to come out of cash with it?
They'll come in with the extra $2,000. So rather than come in with $25,000,
you pay $2,000.
You're paying $2,000, and you still got the deal. It's the same loan amount, the same interest rate, the same everything. Now that same scenario will work even if the guy's only putting 10% down at the beginning, because you can go, the bank will finance all the way up to 95% loan to value of the appraised value, because as a lender, we have to lend on appraised purchase price or appraised value, which is ever less, okay? So we're always gonna lend on the appraised value, right? So even if somebody's putting 10% down, right, and that property comes in at 475, now their loan to value is going to rather be 90, it's going to probably be 94, right? In the same instance, it'll be 94. Well, they're already paying mortgage insurance of X.
It doesn't matter.
The mortgage insurance is going to go up a tad bit, right? So
how about if they only qualify for like 10%, their like total debt ratio and all that stuff when it comes to that point? Like a 10% down or 20% down?
No, the loan amount's going to stay the same. We're keeping the loan amount the same. It doesn't matter. The loan amount is going to remain the same. It's always going to be $400,000. That just means their loan to value is higher. The DTI doesn't change because the loan amount stays the same always, right?
Doesn't make sense.
See, that's right.
Makes sense.
Yeah. See. Okay.
So look, if you got a mortgage,
Let me say it again. You're buying a house for 500.
Yeah.
You're putting 20% down.
yeah, it's 80 grand
So now you've got
or 20.
It's so basically you've got a $500,000 house
Yeah.
times 80%. You've got a $400,000
Yeah,
loan
400
amount.
loan. Yeah.
Okay, $400,000 loan amount. Now the house
Oh,
comes in
100
at
grand. Sorry. Yeah.
yes, the house
Yeah.
comes in at 475. We're 25 grand short.
Yeah.
We're not going to bump the loan amount up. We're going to keep the loan amount at 400.
400K. Where's the 25K come from?
All we're going to do is take the 25K from the 100,000 that they were putting down.
Oh.
They're now putting down 75. The 25
I
gets
get
slid
it.
over to the
I
other
get it.
side.
You're moving money. That's already
It just,
there.
it's there already.
It's already there. You're just
They're-
ratioing the mortgage.
right. They're,
So, but if
the borrower is still borrowing 400
I
grand.
get it. So then you move the 25K, and then ultimately you pay that additional insurance, blah blah
Exactly.
blah, $2,000,
right.
and away you go.
But what happens? 99. I had this happen. I've seen it happen in front of me at an open house with another realtor at one time. They thought that I heard her talking. Oh, well, you're gonna have to come in with an extra $80,000. She got off the phone. I said, hey. What happened here? To explain this. And she told me, I said, your borrower doesn't have to come in with 80 grand. What do you mean? And I told her about this and she was like, what? And she wasn't using me as the lender. It was another lender. She's like, hey, can you call my lender and explain? And I did, and they saved
No, it
the
makes
deal.
sense. But I mean, the only difference is now, like, you're going to be paying that additional, what'd you call that? Insurance what?
Mortgage insurance.
But you're paying, said, $2,000 towards what?
It's to buy it out. So you don't
buy it
have
out.
it monthly. Or you can just say, hey, the mortgage insurance is $50 a month. I'll pay the extra $50 a month.
But what is it?
and not have to come
Usually,
up with
like,
25 grand.
on $500,000, what would it be mortgage insurance be? Like,
On $400,000 with a great credit score and a low DTI, your mortgage insurance it's going to be less than $100 a month.
for how long? For the
Term, well, it's
Term
for,
loan?
It's there's a formula there. It's either till you have 20% equity in the property,
I see.
right? Or it'll drop off automatically after you've got 78% in there, right?
Okay, so you can bump it up. You can, in the year, you can put in 20, 30 grand, get it up to 20%.
Yeah, you could do it. That's another.
And then
It's
it's just-
another conversation. You could, yeah, you could
can
do
pay it down a
buy
bit in
down.
the year,
Yeah.
and then
You
avoid
could
that.
it's called a recast.
Okay, so
Yeah.
worst case scenario, $1,200 for the year.
Well, possibly.
Yeah,
That's the-
if you put the additional money to offset the 80/20, and then that's it. Or you pay that 2K buy down.
single premium.
Single
You
premium.
buy down. My point being is,
There's ways around stuff.
if you're putting 10% more or down on a property and the appraisal comes in less than the purchase price, you don't automatically have to think, if I want that house, I have to come out of pocket with that money. You don't. You're already coming out of pocket with your down payment money. All we're going to do is take the money for the down payment. We're going to keep your same loan amount, and we're just going to slide the money
Amazing.
to the-
Do graphs,
Yeah.
and Alex will add it to the
Yeah.
things.
Yeah. So that's just a little bit of a trick that
I'm going to touch on that. Why that came up as well is because we had a deal, and again, this is not just one. There's a few of them now. One of them was one of my investment properties that we built and we sold, and the appraisal came in $45K less. So I don't know what's 700 on 650. What's that? 5%. My math is horrendous
Whatever.
since AI
Yeah.
has been around. But
Right.
let's say 5 to 7%. It
since
came.
AI, since calculators.
No, but before that was good. But it's AI screwed everything up. But anyway, 5 to 7%. I think it came under, right? So you look at these appraisals, and again, why is this thing coming down so low? And then you look at what they're appraising at, things that don't make sense. Like the appraiser had one property, and that was 500K with no pool and a whole bunch of stuff. So to get it up to 700,000, you need like $200,000 of add-ons, which is a erroneous comp, let's call it. And so we look at all these comps are erroneous. So long story short, it came in like 6 to 7% lower. What we did is we asked for a reappraisal. I wasn't going to take the loss. I know they're maybe coming back for money. I'm like, I'll just relist it. I said, it's the value's there. I said, it's not. We're not going to subtract it off of this moron's appraisal. And literally, we got to reappraise. They appraised at 100%, 695 what we sold it for.
Yeah.
Okay, so that's one deal. The other deal now, we had one. Just recently in Verdana Village, and it was a simple model. It was a scenic series, so 42 foot lot. There was 1 million sales, okay? Before I went on the listing presentations with my client, I sent them like an average. It's 5 sales. You're averaging between 435 and 450. Okay,
Yeah.
that's what the average is last year, like the last sales. That's fine. Or 445 to 450 or some shit like that. Anyway, so we put it together. We listed aggressively, like to sell it. We had a great house, self exposure generator. One of the best lakes, let's call it, lake lot rather. And we listed at 469. We blow it at a 465, I think, something of that nature. Yeah, 465. And the appraisal comes in, and then I look at this appraisal, and it's like 10,000 below what we sold for, which is impossible because even the stuff that was like landscape views and crap units were selling for 445. So how do you figure our unit? So then you look at the appraisal, and again, this shouldn't be my job because it should just automatically be their job to get it appraised properly. They were using comps from different communities. They were using comps from the place across the road, but not even a Pulte product. It was a Lennar product, and it was a larger home. It was an executive rather. So it was all like mismatch of and I called it on them. And again, it wasn't me and my client. We spoke, we were going to give them any money back. They did a reappraisal. It came in at its value. But it was just like, again, we're being challenged. If you're not, I don't know.
Did you do a new appraisal or did you do a reconsideration of value?
No, they did a reappraisal. Sent in a new appraiser in.
See, because
the appraisal didn't want the appraisal.
A lot of times, the lender won't allow for a second appraisal, right? If they've already seen the first one, right? Because then they're going to have two appraisals. They're going to always take the lower of the two most of the time.
Yeah.
But the first step is always you want to do what's called a reconsideration of value. So we get that appraisal in, we see it's less, and we go back to the agent, and the agent can provide us additional comps to give to the
two separate appraisal companies on both these properties.
Yeah, no, I know, but I'm saying the first step would always be
they asked, and they wouldn't reconsider.
Okay.
Both appraisers were head in the sand. They were too proud to
But that's typically your first. Yeah. And then, of course, an appraisal is one man's opinion, right?
But it can jeopardize seller, jeopardize buyer, and it screws the deal up.
Yeah.
And if it's a bad appraisal. But I mean, being like a veteran in the industry, you can go back and provide, like we did, basically give them a whole CMA and why they devalued the property and what they should be added in, which is insulting to them. I get it. But at the same time, like, we have to protect our sellers.
Yeah, that's a lot of times it's pride with those guys, right?
100%.
They don't want to admit that they missed something, right?
Yeah.
So, and you're going to have that. I mean, it happens. And most of the time you can get it turned around. Either the reconsider value works, or you use what we call it as an appraisal gap strategy. So, anyway,
okay, we'll move on to next